Let's bring in our next guest, Scott Bauer, CEO of Prosper Trading Academy, to the show. Scott, welcome to the show. As always, great to have you here. All right, I'm jumping right in here, my man, and I'm going to hit you on a bunch of stuff. So first up, I'm kind of curious. Last week, big sort of rally coming in. It felt like coming into this week, we had that momentum yesterday, and then we just sort of fell flat. But then last night, we kind of got that pushback here again, but I feel like we have another little exhale coming. As you're looking at the equity market side right now, are you seeing this as being sort of that sort of oversold bear market bounce, or are we kind of getting to that point where we're starting to turn the corner?
You know, that's a really good question. We're all talking about it, and I still think it's an oversold bounce, unfortunately. What I do like, what I think is very positive, though, JB, and you know this, after we see a really strong move one way or the other, we typically like to see some consolidation here. So I think it's really a positive that yesterday we didn't give back half of what we gained last Friday. You know, with the markets by the end of the day were just slightly in the red, couldn't hold the gains, but I think that's a positive. But I do think overall, JB, this is just part of a bottoming process, part of a rally out of, you know, hopefully out of the bear market, right, but really a bear market rally.
No, totally fair. And that's sort of as we've been looking at it, it feels as though this week is a little more economically driven with comments coming through. And I just, again, there's a lot of data here, less earnings, and it feels like that's sort of coming into play. It felt like Lagarde's comments here of saying, hey, we're ready to go, but we don't see a recession, kind of gave some momentum into Europe, and that came through. One of the areas that I thought was interesting to kind of continue to watch that was the Treasury complex, and specifically yields. For our traders, the 10-year is sort of that benchmark they always look at. We've been inching higher on yields, yet also inching higher on the equity market. So my question is can we have both going forward here? Because usually we would say higher interest rates, that was that first headwind, I would say, into the equity markets.
You absolutely can have both. And I think what we're seeing, at least right now, is maybe a little complacency, a little acceptance. That shock of seeing the 10-year, you know, hit 3 and then almost hit 3.5%, you know, that has now faded a little bit. So there's a little bit more of an acceptance of a 3 handle on the 10-year. Now, we're certainly up significantly from where we were at the bottom last week when we came all the way back down just about to 3% off of those 3.5% highs. We're back at what, 327-ish or so right now. But I think what you're seeing is the market just accepting that right now. Now, can that sustain itself? I don't think so. I think there's still too much weighing on the overall market. I think there are too many headwinds. But for right now, at least into the end of the quarter on Thursday, I think that, you know, that can sustain itself, and probably into next week, or at least before, as you mentioned, the earnings season starts again.
Yeah, because part of what I'm interested in is sort of taking those Fed comments that came out, right, and really looking at the CME tracker tool. I think it was like 73% of a 75 basis point hike here coming in July, and then another 50 bips, I think, was in September. Interesting to me to see those still holding, but kind of that 23 vision has sort of pulled back with no interest rate cuts. So that was kind of what I was interest rate hikes, maybe even moving into cuts. It was interesting to see sort of the way that the yield curve has continued to move along with that. And it felt as though that kind of gave a little something to the markets yesterday. But then, of course, what do I know? We lost it along the way.
No, I think it did. And you make a really good point about 23. In fact, the futures projection have gone from like 4% down to about 3.5% by end of first quarter 2023. I think that's a really big positive. I also think, JB, and I've had this discussion with both Ben and Oliver, I really think that we do have a real opportunity that the Fed actually pulls back or reduces rates, maybe not so much by the end of this year, but by first quarter next year.
Yeah, so that'll be interesting to see kind of how the markets start to react to it, because that felt as what we heard from Lagarde, which was what we had heard previously in the U.S. is we're data-driven, we're going to make decisions when we make them, versus now where we kind of keep saying, here come those more, we're going to hammer inflation. That seems to be a different. One of the products or one of the asset classes in my mind that's got a beneficiary of this interest rate push, the dollar. And really another one of those examples, right? Yields are higher. Looking here again today, dollar is up again. We're holding just below 104. As you're looking at this dollar, it sort of has now sort of stopped its downward trajectory off of its yearly high of 105.56. What do you see with the dollar as you're looking at it going forward here?
I think you have to be a buyer on the dip. For a very long time, we were in the equity markets, we were buying the dip. You have to do that with the dollar right now because there are so many tailwinds for the dollar. And it has struggled a little bit just, over the last week or so with softening inflation expectations. But yes, when we saw the dollar come off that 105.50 number down to in the mid 103s or so, that's absolutely a buy the dip right now. And I don't see that changing over the next quarter or two.
Do you feel as though some of the comments out of the ECB, as well as what we've been watching sort of out of Bank of England, right? So, obviously you had the surprise rate hike from Swiss National S&B. You had Bank of England come through. I think it was with its fifth consecutive rate hike. Yep. You got ECB come through here. Because oftentimes we talk about the inverse relationship or the impact of, let's say, the euro and the pound can have on that dollar. It does feel as even I'm looking, both the euro and the pound are weaker so far this morning. It feels as though the best place in the block still is in the U.S. Despite those kind of pushing up there. It sort of has helped kind of sustain the dollar. It's not letting it kind of shoot back down to that 101 level, which it was back in May.
Well, I think that's what it is. And it's best of, I don't want to say it's the best of the best, but versus the alternative, that's why I think there's major tailwinds and why you've got to buy the dip in the dollar because of the euro, because of other currencies, which are really just lagging. But the word, what Lagarde said this morning here, this is pretty significant, JB, because they're looking at bringing their deposit rate back out of negative territory for the first time since 2014. That's a pretty massive move.
Yeah, no, absolutely. I really feel as that a lot of the bid was at that 1 o'clock announcement when it came through across the marketplace. It was just really intriguing and interesting to see the markets react. I mean, they sold off a little bit, but they've held pretty good.
Yeah.
So I'm very curious to see kind of what continues to come out of the U.S., not necessarily in response, but it feels as though that's what the markets wanted to hear in Europe. And now we're kind of coming back here where you're now saying to people, I've heard a couple of people come out and say, maybe we're not quite in a recession. Maybe we're getting out of this, or we're already in one and we have an opportunity to kind of get out of it. Whether or not, to your point earlier, whether or not the Fed needs to now start to pause a little bit from its aggressive stature here or focus toward it. One of the ones I wanted to pivot to here quickly, gold, normally an inflationary move, not really doing anything out here on the radar. Is this even on your radar at all? Or are you kind of just sort of pushed it to the side saying, hey, until it gets some conviction one way or the other, I'm not going to deal with it?
Well, that's why it has been on my radar for the last, probably month or so, because just what you and Rick were, talking about in the prior segment, this thing has consolidated. It hasn't moved. And we're waiting. Everybody's waiting for the breakout. Is that breakout going to be to the upside? Is it going to be to the downside? And, you would think just the general fundamentals of gold with everything going on with inflation, interest rates, economic headwinds, to me, gold should be trading with a 19 handle, maybe not up at those highs in, 2000 or so. It has just consolidated. I think we're all waiting for that next move. Which way is it going to be? If I had to predict and make a guess, JB, I'd actually think it's to the downside.
Yeah, I mean, especially if you're bullish dollar, right? That's going to have that inverse relationship on gold as well. I totally get it. It's just been one of those intriguing markets to me, and I think if I go back to my Econ 101, it's supposed to be going up. I'm not really sure I should go.
Right.
I got to go talk to one of my professors and be like, hey, what did you teach me here? It didn't work out. Last one for you, because it's another one that I'm kind of surprised watching going, and again, I kind of wanted to hit those sort of inflationary and sort of risk on the VIX. Just looking at the VIX really starting to sell off. It's been an interesting one. Like I was going back, right? 34 back in early to mid-May, sold all the way down to June, down to 24. Rally back up to 34 in the beginning, mid-June. Now all of a sudden we're back down here hovering sort of in the 27 frames. What is your view on the VIX right now as you're looking? I mean, that's a great chart here. Just see the yo-yo back and forth.
Yep. So, people were waiting for that big capitulation moment to see that, 40 handle on the VIX, which typically in the past has been, okay, when we get up there, that signifies a bottom of the market. We never saw it. Don't know why we didn't see it with all the pressures in the market. I do think VIX to me is like the dollar, JB, where you've got to buy it right now on any dip. I'm targeting the 25.5 to 26 level. If we get back in there, the trend is, as you just pointed out, it's going to yo-yo back up from there. Now, historically, who wants to buy a 25 VIX historically, right? When the historics are in the mid-teens, but in this environment, you look at, a smaller timeline chart, I think you have to. I think that's just a good opportunity here to hedge, a position, hedge a portfolio. So I don't think the VIX is going to get much below the 26, 25.5 area. That to me is a buy level.
No, Scott, I mean, again, I think it's great. I always appreciate you coming on the show, talking a variety of products, but again, really kind of talking about those sort of risk-off assets that have had sort of an interesting relationship here, getting into the last week of the month, last week of the quarter, and getting into that true summer session. I appreciate you coming on. Great to see you on the train, by the way. I got to catch you on that train. Get that beer, the train beer with you here soon. So thanks a lot.
That's on the way home, not on the way in.
True. Good point. Everyone, thanks a lot. That was Scott Bauer, CEO of Prosper Trading Academy, joining us.